Good morning, everybody. This is Patrick MontesDeOca with Live Trading Talk for February 22nd, 2022. Welcome, everybody, back. I hope you had a great weekend. We have some developments here over the weekend with regards to Russia. The tensions are escalating as Russia has agreed to acknowledge two separate separatists, as what they call, two areas northeast of Ukraine are recognized by Russia. So this is causing a great deal of tension. The United Kingdom has already issued pretty much some, you might say, restrictions to the banking system, to healthy individuals. And, we're going to begin to see a deterioration possibly if Russia decides to continue to invade. I believe they already have moved in some troops into that area. And so let's see what happens here, but it is causing a great deal of volatility in the market. The silver market is up to 24.26, up 27 cents. The gold market is 1904, trading back above the 1900 level once again. Let me allow here for a few moments for the market here to settle down here after a long weekend. I think we're coming into a situation here from a trader's point of view that it is a little bit confusing for most people because you have so many different black swans potentially developing here. You have the Russia situation building. The tensions are pretty much globalized here. China is very, very quiet, and that's suspecting of something potentially can happen there as well. You never know here how these two countries are going to begin to put a lot of pressure to the Western economies, to the United States economies, particularly as we move into this environment with regards to the world debt. You're talking about a unsustainable level of debt globally that exceeds maybe 130% of GDP. And so it certainly puts a lot of pressure in terms of the currencies, integrity and maintaining purchasing power without anything behind. They are completely fiat currencies. And so the potential is that as the governments continue to print more money, more stimulus to basically maintain the status quo, so to speak, as inflation is running at 7.5–8%, so they say, and private sources seem to indicate that inflation is running as high as 15%. Nevertheless, there is a shortage of foods developing here. It's just a big mess in terms of coming back here to what the real economy is going to look like. On top of which we have this geopolitical pressure that is putting a tremendous amount of pressure on energy prices. Crude oil. Potentially, we're going to see crude oil trading at $100 a barrel. And that is not positive for world economies. So, coming back here to the markets, obviously this is causing a flight to safety, possibly into precious metals, as we begin to see basically a tremendous amount of pressure put on the bond market. Interest rates, although the 10-year note, it's still running under 2% here. Nevertheless, we've seen a sharp increase in interest rates that is causing the economy basically to have to be recalibrated completely. And that goes for wage pressure. We're beginning to see, obviously, people demanding a higher wage increase in order to adjust to inflation. There is a huge gap that we have between the 10-year note and inflation that has to be narrowed. If we don't see that, or if interest rates do run up quite sharply, as some people seem to indicate, up to 7-8 times, according to some of the major banks, that would certainly put in the nail in the coffin, so to speak, to a recessionary period once again. So there are severe consequences in terms of the application of interest rates, or how fast they move with regards to inflation. Or basically what has to happen here is that inflation has to come down. It has to be subdued. It has to kind of narrow that spread, as opposed to interest rates rising sharply. We've already seen interest rates rise sharply from around January of 2020, roughly at about 0.3538%, I believe, into what we're looking at, 2%, 2.5%. That is a phenomenal move within 2 years in interest rates. And so anything sharper than that, I believe, is going to exacerbate the expense, basically, of financing the debt, individual financing. The cost of money across the markets is going to have to be recalibrated. And we're looking at a potentially collapse in the leveraged aspect of the markets, as people have entered those markets for the last 2 years literally with free money. And so there is still, I believe, a lot of uncertainty in the monetary system and the financial system that is causing a great deal of uncertainty. And that's essentially when you look at the price of gold, metals. Gold is trading at over 1900 again. Now, let's see how we make money here with all this fundamental news that is bombarding basically Main Street, and most people are not sure what to do. We have a great deal of panic at random in the markets here, and now we're dealing with the panic of potentially Russia, invading Ukraine. It seems to me that it's already been invaded. They already have the troops there, and so for the life of me, I don't understand, and that's my opinion, why sanctions have not been implemented sooner. So that's a political situation, and I'm using some of those fundamentals actually to see how I can monetize in the market here. So basically what we're looking at on the charts here today, we're looking at the daily data, and we're looking at the weekly data. And so if we take a look at the weekly data, the average price for the week is $18.84. The extreme level above that mean or standard deviation one-on-one is basically the sell one level of 1922. That is a 50-90% standard deviation. The sell two level of 1943 is a 50-95% standard deviation. The extreme below that mean of 1884 is the buy one level of 1863, which has a 50-90 standard deviation one-on-one, 1-to-1. And the buy two level is a 2-to-1 standard deviation, 50-95%. Excuse me, I wanted to share that information for those traders that are basically trying to understand what this is. This is the mean reversion principle, basically. Reversion to the mean with two standard deviations above and below that mean. And the algorithm identifies these levels in color. These are pivot points that we use that are integrated in the algorithm that identifies the average price in green. The buy one, buy two levels, where you have the highest probability of buyers coming in, is in blue. And the sell one and sell two level is in red. So if we look at the weekly data and see what the market has done, the market traded above the average of 1884. On the 17th of February. Once it traded above there, it activated these levels above of 1822 to 1943. And adjusting these levels to this week here as we come in, basically, the high here was 1918. Now, if we take a look at the right of the chart, the sell one, sell two daily levels for today were 1915 and 1923. And we came in here, the market came down below the daily average and activated this buy one level a couple of times. It activated it at about 5:30 p.m. on the 20th. It came down again to a low of 1891 at 8:30 p.m. and made a final low at about 11:15 p.m. Reverting from there and forming what you see here is buyers accumulating at this level. When the market traded above here on the 21st at 12 a.m., and this action happens on the Globex. This is where it seems most of the action happens, and I'm showing you that all through the different sessions, how the market or how the VCPMI is applied in any market condition. Globex, daily, Hong Kong, or whatever time frame you trade. And it gave us a buy signal short term. The target was completed at 1902. And this was at about, in fact, as we came in, not today, but this was on the 21st. The same pattern was unfolding. The target was completed at 1902 from the buy one level of 1894. And then the market went up into a bullish price momentum all the way up to 1913. It completed the daily targets a few times. It traded there and below, activating short triggers. Once the first target is completed, it goes neutral. Then obviously it activated bearish triggers all through this session, all the way to about 11:15 p.m. on the 21st. It activated a short trigger that unfolded into the mean. This is the reversion to the mean, which I referred to. This is the standard deviation that you see here that reverts back to the mean, and the extreme below the mean coming down to a level, a buy one level that identified the algorithm to buy once we get the signal, which we did, and we basically follow that signal to all of our traders here in Discord live and took the profits here that you see. just to share with you basically how we teach and coach our subscribers here. You can see the comments that were made before this live show at 7 a.m. And it was a really quick trade that we did for day traders, and we pulled out about $1,800 on the silver position and about $3,000 on the gold position, and we went neutral. We took profits, and we did one contract each. And so it was a nice day trade. And this is basically how I apply the VCPMI as a GPS for my trading. This trade was done in the gold market, and you can use the same methodology as you also trade in other instruments. Here in this case, silver, same thing. The market traded above the daily average, the weekly average. And once it trades above the averages, what it does is it activates a bullish price momentum. And that is basically the momentum of the market within the bigger trend. That is the underlying trend of the market. And obviously, if we look at silver, it seems to be on the verge of what looks potentially a major move up taking place, which could take silver all the way up to about 26, at least, which is the upper end of this trading band that you see here, long term. The low that was made here was on September 28, when the VCPMI anticipated a seasonal low to take place. That seasonal low was tested on December 15, making an annual low, which was a higher low than the seasonal low. And the market has reverted from that level through. Now, what you see here is a set of prices here that are all the way up into that 24.75 level, which is really the weekly sell-to level, and that is potentially the resistance level that you see here. That is basically the ceiling that we see, and we want to see a lot of strength, a lot of green bars here continuing to break through this resistance, because once we break through this, then the next target would be about 25.50, and pretty much there's nothing above there all the way up to about the 26, 27 area. So we could, potentially be looking at about a $3 move in silver really fast. We're at a point where the price of silver is going to be looked at as a hedge against not only the monetary collapse that we're looking at by the incredible amount of stimulus that is floating in the marketplace, but the economic, aspect of inflation, higher interest rates on top of geopolitical, maybe too much risk to carry, for the US dollar as a currency. Now, even though if we do enter into some kind of confrontation, it is bullish for the dollar short term. That is usually where most of the money goes into when there is a political conflict globally. But from a purchasing power, obviously, point of view, it's pretty risky to put into an asset that has a negative yield. If you look at inflation and just the 10-year note. So the market is entering in gold and silver into a resistance level, and either we're going to take out the resistance of 1923 all the way up to 1943, take out the previous high that we made. We almost took out 1819. $1918.30 was today's high. So we are on the verge of this, what could be a breakout or a reversal pattern, a reversion to the mean pattern. Now, this geopolitical situation, obviously, and inflation is really putting a lot of pressure on the Feds. They are really caught between, a rock and a hard place, so to speak. And so it's going to be very delicate how the market perceives their next move. And in my opinion, I believe that what probably will be is a set of 1/4 point increases, and then see how the market reacts and see how the data reacts, basically. Or the market reacts to that data, whatever that data may be, fundamentally. But it is a highly volatile market, and don't buy into the news. Look at what the market is telling you, and we need to break out of here if we cannot get through this resistance. With all of this economic and geopolitical pressure, it could be setting the market up for a bull trap. So let's see what the market does in gold and silver here. I haven't talked much about Bitcoin here, but Bitcoin continues to be manipulated, you might say, by the rhetoric that's going on with regards to regulation, with regards to confiscation, regulation, and uncertainty, and a lot of risk obviously has got into cryptocurrencies, and the market will settle down here, and I believe what you're looking at is, once again, in Bitcoin, for hodlers, as they say, hold on, buy and hold on to this, because the Bitcoin will adjust to the economics, you might say, of what's going on. And it also is considered a hedge against potentially what we're talking about here. One mention that I wanted to share with you, obviously, if we look back here just a few months back, or at the beginning of the Olympics, Russia and China agreed to leave the US dollar SWIFT system in the exchange of gas, natural gas, with China is being paid now in exchange in Eurodollars, not US dollars. And I think this might have been in preparation to what obviously it's coming here. So, keep alert, and let's just be very sensitive to all of this going on here, and see where we can see some great trading opportunities here. Once again, great to be back here, and have a great trading day, my friends here. In the meantime, I'll talk to you soon. Be well.